Short sellers have pulled $8 billion out of bets against a single private aerospace giant in just 60 days, a liquidation of short interest on a scale never seen before. On CNBC recently, S3 Partners founder Bob Sloan sat down to explain why this specific stock has become the most systemic and frothiest trade currently impacting the broader markets. By the end of this video, you will understand how this trillion-dollar entity has evolved into a gravitational force that is actively dictating the direction of the entire technology sector. I want to show you how a single massive private asset is secretly pulling the strings of the entire public market, serving as a multi-billion-dollar gravity well for tech stocks. I'll play you Sloan's CNBC interview uninterrupted, and after that I'll give you my own reaction breakdown to what he said.
Here with more insight is Bob Sloan. He's the founder of S3 Partners, which provides market data on positioning within stocks and sectors. I can't start with Cisco, though. Do you know where I have to start?
Tell me.
Do you remember what you said the last time that you were on with us at the end of June?
Yes, I do.
You warned about the memory trade.
Yeah.
Do you know what day the memory trade peaked? June 22. Yep. So, Bob, as I lean in, what do you, and today we have DRAM rebounding to the tune of 8%. Can people jump back in there? Are there new areas of leadership? What's going on?
So, SpaceX kind of rules all, and that's the gravity by which everything else is pulled towards. So, yeah, you're seeing a lot of short covering in that, and you're seeing short covering across the board, like in stocks like CoreWeave, et cetera. We're seeing a lot of that.
Let's go back to what you just said. SpaceX rules all. I mean, I thought this was a stock that was set it and forget it. Retail buys it, they put it away. It's a generational thing. You say it's much more important than that.
Yeah, it is. It's a trillion, $750 billion dollar IPO. It's the biggest IPO on the planet ever, and everybody owns it, and it affects everything. So you're either a believer or not, and that you either kind of say it rules the world or it doesn't. Mm-hmm. And the amount of short interest bets on SpaceX has gone to $32 billion down to $24 billion in 60 days.
But
we've never seen anything like this. Have you ever seen anything like
He's
that?
cleared out the shorts to that extent, you mean?
Yeah.
Okay, so again, I would say this is an idiosyncratic Elon Musk story. Why is it so important, and what does it tell you about the broader markets?
Well, technology, software, memory, I think certainly SpaceX is probably the frothiest trade ever. It bleeds into other sectors and has an effect. And you're seeing that. When that stock moves, it moves other things along.
It's wonky, and I don't want to go too deep into it, but if you look at something like Delta One, which is like a strategy for synthetic baskets of stocks on Wall Street, our retail audience doesn't do it, but hedge funds do it. Tesla used to be the most important stock in the world because it was in all these Delta One option strategies. People hedged against it, right? There's a lot more to a SpaceX and a Tesla, these Musk stocks, right, than just the stock itself.
Sure.
They influence, I think what you're saying, all these weird other things that we never think about.
Well,
you guys think about them,
but
our viewer at home is probably, what's that?
Is SpaceX a memory stock? Is it a launch stock? What is it? Is it a satellite stock?
AI.
There's so many different
Grok.
things, and that's why it has an effect on so many different sectors.
So Bob, and you just mentioned the short interest has gone down. Stock has kind of rebounded quite a bit.
Yep.
Have the shorts then moved on to other parts of the AI trade, saying, hey, listen, we don't want to mess with SpaceX, okay, because it's just other things happen. So, you mentioned CoreWeave, you mentioned some of the memory stocks. Is that kind of starting to back, as soon as these things get the momentum, do the shorts start pressing on that area, or are they kind of looking at other areas in the market now?
Well, positioning matters more than just what the short sellers are doing, right? So I think one of the things that we're looking at is what's the ratio of active longs to shorts in things that are adjacent to SpaceX. So, for example, like, Viasat, Planet Systems, those stocks are skewing long. And so those things are, I would say, pro-SpaceX on the Elon Musk influence side. And then you have things like Intuitive and AST Space Mobile, which are skewing to the negative side. And because they're seen as being competitive to Elon Musk.
The anchor initiated the conversation by looking back at Sloan's previous appearance at the end of June. During that prior discussion, Sloan had issued a stark warning about the memory trade, predicting it was reaching a near-term top. As the anchor pointed out, that call proved to be incredibly precise, with the memory trade peaking on exactly June 22nd. Now, with DRAM rebounding by 8% on the day of the broadcast, the host wanted to know if this was a genuine buying opportunity or if the market's leadership had fundamentally shifted. Sloan's response was not what most commentators expected. Instead of offering a standard analysis of chip inventory levels, server demand, or product cycles, he made a massive claim: space kind of rules all, acting as the primary gravitational force that pulls every other sector in its wake. He explained that the intraday rebound in chip stocks and other technology names was not necessarily driven by organic buying, but rather by massive short covering across the board, specifically mentioning names like CoreWeave. My take on this is that it completely redefines how we must analyze technology sector momentum. For years, investors have treated semiconductors and software as independent ecosystems governed by their own capital expenditure cycles. But if Sloan is correct, the entire tech complex is increasingly behaving as a downstream derivative of a much larger, highly speculative space trade. When short sellers are forced to cover their positions in space-related proxies or leveraged tech positions, the resulting squeeze ripples outward, lifting the entire Nasdaq. It is a fascinating dynamic because it suggests that public market prices are being dictated by the friction points of private market valuations. Sloan pointed out that we are no longer dealing with isolated speculative bubbles. In the past, you had the dot-com bubble, the housing bubble, or the clean energy craze, each contained within its own regulatory and public trading sandbox. But today, the sheer scale of SpaceX's private valuation, which has climbed toward the $200 billion mark, has created a parallel financial ecosystem. It is an asset class that is virtually untouchable for the average retail investor, yet its financial gravity is so immense that institutional traders are using public tech equities as liquid hedging vehicles. If an institution is long on private space assets but needs to manage their risk or find liquidity to fund their capital calls, they do not sell their private shares. They trade public semiconductors, software, and highly leveraged AI infrastructure plays. This was exactly where the CNBC anchor pushed back, asking how a single private entity, no matter how large, could possibly exert that much systemic pressure on highly liquid, multi-trillion-dollar public markets. The anchor's skepticism was entirely fair. On paper, the public market capitalization of the S&P 500 should easily dwarf any private company. But Sloan's explanation cut straight to the plumbing of modern Wall Street. He explained that the traditional boundary between public and private equity has completely dissolved. Major investment banks and market makers are now running massive, highly sophisticated secondary trading desks dedicated entirely to private shares. When a private giant like SpaceX undergoes a secondary sale or a tender offer, it triggers a cascade of margin adjustments, collateral revaluations, and capital reallocation across those same prime brokerage desks that service the world's largest hedge funds. If you're getting something out of this, a like genuinely helps, and subscribing to the channel helps even more. My take on this phenomenon is that it exposes the hidden leverage in the system. The reality of modern institutional investing is that private assets are frequently used as collateral to secure cheap leverage for public market bets. If a hedge fund is sitting on billions of dollars of paper wealth in a private company like SpaceX, their prime broker will gladly extend them credit to trade public equities, buy high-yield debt, or short-sell competing tech sectors. But what happens when the private valuation gets marked up even higher? The fund's borrowing capacity automatically expands, allowing them to pump more speculative liquidity into the public market. Conversely, if there is a liquidity pinch, those same prime brokers might demand more liquid collateral, forcing these funds to suddenly dump their public holdings or cover their short positions in a panic. It is a highly circular, feedback-driven loop where the private tail is wagging the public dog. Think about it this way. Have you ever wondered why a perfectly healthy public tech company, with solid earnings and growing margins, can suddenly see its stock price drop 10% in a single afternoon for no apparent reason? We like to blame algorithmic trading or macro indicators, but the truth is often far more hidden. It is highly likely that a major institutional holder was forced to liquidate that public position simply to meet a capital call or a margin adjustment originating in the private market. This brought the conversation naturally to CoreWeave, a name that Sloan explicitly flagged as a key node in this liquidity web. The anchor asked Sloan to clarify the relationship between a private AI cloud provider and the space-dominated gravity well. To understand Sloan's point, we have to look at how CoreWeave has structured its explosive growth. The company has made headlines by securing billions of dollars in debt financing, using its highly coveted NVIDIA GPU clusters as collateral. The company is NVIDIA, ticker symbol NVDA. Sloan's insight is that this leverage model is not operating in a vacuum. The massive capital expenditures required to build out AI data centers are directly colliding with the infrastructure demands of the global space economy. We are seeing a convergence where satellite constellations, global telecommunications, and distributed AI computing are merging into a single capital-intensive megatrend. My take on the CoreWeave dynamic is that it represents one of the most aggressive experiments in asset-backed leverage we have seen in decades. By using NVIDIA chips as collateral to borrow billions more to buy even more chips, CoreWeave has created a self-reinforcing liquidity engine. But this model relies on one critical assumption, that the market value of those GPUs remains sky-high and that demand never falters. If the pricing power of AI compute begins to normalize, or if space-based edge computing networks do not commercialize as rapidly as projected, the collateral backing those billions in debt could rapidly depreciate. Sloan is warning us that the short covering we saw in these names isn't a sign of fundamental strength. It is a defensive reaction by short sellers who realize that the liquidity backing these private-to-public structures is far more resilient than they anticipated. This is where the structural narrative of the market takes a dramatic turn. The discussion shifted from localized tech dynamics to the broader macroeconomic picture, specifically how the Federal Reserve's interest rate policy is feeding this private market monster. The anchor questioned whether a sustained period of higher-for-longer interest rates would eventually starve these private gravity wells of the capital they need to survive. It is a logical question. Traditionally, high rates are toxic for highly speculative, long-duration private assets because they raise the cost of capital and make safe yields more attractive. But Sloan's response flipped this traditional economic theory on its head. He argued that instead of starving the private market, high interest rates have actually accelerated capital concentration. When capital is expensive, institutional allocators like sovereign wealth funds, massive pension funds, and family offices become incredibly risk-averse. They stop scattering seed money across hundreds of early-stage startups and instead concentrate their massive cash reserves into a select few too-big-to-fail private champions. SpaceX, with its near monopoly on launch capabilities and its rapidly expanding Starlink network, becomes the ultimate safe haven for growth capital. Consequently, billions of dollars that would have normally flowed into the public microcap or midcap sectors are instead being hoarded within a handful of elite private companies. My take on this concentration thesis is that it creates a highly distorted, two-tiered market. We are seeing a select group of private megacaps that enjoy all the benefits of public-scale liquidity without any of the regulatory burdens, quarterly earnings scrutiny, or public short-selling pressure that public companies must endure. This concentration of capital artificially inflates their valuations, which in turn inflates the borrowing capacity of their institutional backers. But it leaves the rest of the public market starved of oxygen. It explains why the current market rally has been so incredibly narrow, dominated by just a handful of public tech giants, while the average stock struggles to break even. The private gravity well is effectively cannibalizing the rest of the financial system. Look at the broader indices. If you strip out the top handful of tech performers, the rest of the market has looked remarkably flat over the past year. It makes you realize that the traditional metrics we use to evaluate market health, like price-to-earnings ratios or dividend yields, are increasingly useless in a system governed by private liquidity flows and collateralized GPU assets. What we are witnessing is a fundamental migration of price discovery. In the past, the public markets were where companies went to find their true valuation. Today, the real action, the real leverage, and the real growth are being locked away in private ecosystems, where only sovereign funds and elite institutions can play. When Sloan was pushed on how this ends, his perspective wasn't one of immediate collapse, but of a slow, grinding realignment. The public market is becoming a lagging indicator, reacting to tectonic shifts that have already been negotiated behind closed doors in the private space. My take is that this puts retail investors at a severe disadvantage. If the most explosive growth engines of our generation, from satellite-based edge computing to self-funding AI infrastructure, remain private indefinitely, public market investors are left buying the mature, slower-growing remnants. It forces us to ask whether the traditional portfolio allocation or even a basic index fund can truly capture the next wave of global wealth creation when the gravity well of private capital keeps the best assets out of reach. This leaves us with a critical question to watch moving forward. As the Federal Reserve navigates the next phase of its rate cycle, will we see this private leverage model begin to show cracks, or will the sheer momentum of the space and AI convergence prove too powerful to break? The answer will define the next decade of investing, and it is a dynamic we cannot afford to ignore. The risk here is that the liquidity supporting these private giants is tethered to a very specific set of macroeconomic conditions. If the cost of capital remains elevated, the sheer weight of this debt-fueled expansion might force these players to tap public markets sooner than they would like, potentially triggering a messy repricing event for everyone else. Watch the secondary markets for signs of distress because that is where the true story of this cycle will eventually be told. I appreciate you watching. Give it a like and subscribe to the channel, and I'll see you in the next one.